afternoon, everyone. Good afternoon, wherever you are. As usual, we are very, very pleased to have you join us today. Today actually marks the third edition of our Bootcamp series. Can you believe it's 3 editions in already? And I mean, for those of us that this is your first time joining our Bootcamp series, it's a series where we are seeking to raise 100 million smart investors. Yeah, it's a way of giving back to society in raising awareness to drive 100 million Nigerians to start investing. Um, Today is a very, very interesting one for us. While we wait for other attendees to join, I'll just give a brief background behind what this campaign is about. So the 100 million smart investors campaign is our way of giving back. It's not a product push. Is a way of us sensitizing everyday Nigerians like myself, like from different walks of life, as to how they can build confidence and create awareness around how they can begin their own investment journeys. Starting from the end of this session. We'll be sharing stories. We'll be sharing our personal experiences. We'll be sharing our own personal expertise on different topics. And today's topic is an interesting one. It's something that's been trending both on the social media space and even on the street. Everybody has been talking about is this new tax regime, tax regime. I mean, what's going to happen with our investments and everything? That is what you're here for today. Today's topic is centered around capital gain taxes and your mutual fund investments. And I won't be doing this alone. I have my able and capable colleagues with me today that will be taking us on this session. So sit back, relax, keep every distraction away from you, and try and grasp as much as you can. Towards the end of the session, there'll be a period for you to send in your questions. We'll try and answer as many as time allows us to. So please, whatever questions you have, note them down, put them in the Q&A box, and then we'll be taking them we'll take as many as time allows us to. So I mean, let's dive straight into it. I'll be allowing my colleagues introduce themselves. I'm joined by 3 of them. Ayooluwade, can you start with your? Can you go ahead to introduce yourself?
Yes, Muyiwa. Thank you. Good afternoon, everyone. Feels good to be here. My name is Ayooluwade Ogunwale. I work as a VC income portfolio manager with First Asset Management. I trust today will be a very insightful section for us. Good to be here. Thank you.
Thank you so much. Tunde, do you want to go next?
Yeah, thank you, Muyiwa. My name is Olatunde Oluwatuyi. I'm so delighted to be here. I actually lead the classic segments under investment advisory in First Asset Management. Thanks for having me here, Muyiwa and everyone. Thank you.
And then we have the lovely Shil.
Good afternoon, everyone. My name is Agbeyomi. I work as a portfolio manager at First Asset Management. I'm quite excited to be here today, and I believe we'll learn 1 or 2 things by the end of this session.
Thank you so much, guys. So let's start off on a light note. In terms of our mutual funds, I mean, for the benefit of those who are not conversant with what mutual funds are, or for people that know what mutual funds are but would like to know more, just Tunde, can you help us with a brief explanation as to what mutual funds are and why they are so popular at the moment?
Yeah, thanks a lot, Muyiwa. Looking at that phrase, mutual fund, picking the mutual is more like a unity of purpose, an agreement between 1 or 2 persons. Then the fund, money set aside to achieve a purpose, an objective. So mutual fund is a pool of fund from different investors. Personally, I try to qualify mutual fund as a democracy of fund. I mentioned that a lot in my speeches. And the reason I'm saying that or qualifying it as a democracy of fund is the fact that regardless of your income size, you can always buy some units, regardless of even your personality. And looking at mutual fund, it is actually categorized based on the underlying assets. We have mutual funds that are equity focused. Those are equity mutual funds. We have mutual funds that are maybe fixed income focused. It could be bond fund and what have you. We also have ethical instrument focused. But the most popular one, that's the money market fund, which I like to talk about a lot
Yeah.
because it's a fund that really appeals to the retail market that I always face. So generally, mutual fund had been in the market. It had been in Nigeria even way back since the 90s. And even looking at the history, because I try to do more of reading of history, looking at the history of mutual fund, it had even been in existence since the 70s. Like I'm talking about
Wow.
1772,
Wow.
73. Started in
Wow.
Holland, then from there, the guys in UK took it up. It became that was a form of revolution. But the final revolution actually happened in the United States, where they had to even come up with a regulatory framework to protect investors.
Yeah.
And
Yeah.
Nigeria is
Very
now doing
important.
it, and it keeps delivering values for investors. Thank you.
Thank you so much, Tunde. Thank you so much, Tunde. Ayo, I'm coming to you now. I mean, Tunde has already explained that mutual funds are a collective investment scheme whereby people pool funds together to invest in different asset classes. So how do they differ from directly investing in particular financial instruments? No, so for example, now, how are mutual funds different from buying a treasury bill or a bond or buying a particular share on the Nigerian Stock Exchange? How are they different?
Okay, thank you very much, Muyiwa. I mean, Tunde has given us a bit of history lessons as to the origination of mutual
As a
funds.
prof, as a prof.
Yes. So, all right. So, I mean, so just look at it like this: you have two individual, right? You want to get groceries from the market. One individual goes to the market directly to buy what he or she needs. I mean, the second one uses platforms like Child Deck, where you can easily order at the comfort of your home and they bring it to your house. I mean, at the end of the day, right, they both got products that they needed from the market. It is just the means that differs, right? So look at it that way, right? So direct investments, I mean, simply is just an investor buying whatever they want to buy directly from the market or selling to the market directly. But if you look at it from the mutual fund standpoint, like Tunde said, right, it's a collective pool of fund, right? What you tend to see is under the management of a professional. Right. So if let me take stocks investments, for example, for you to select buy stocks, there is a factor of timing, right? To know the right time to come in and the right time to go out. You can be on a date with the love of your life, right? You're having a good time and there's a corporate action happening somewhere, but you are not privy to such information, right? So you could have taken advantage and made some decent return, but because you're doing it on your own, you're taking all the risk by yourself. You can't be
Yeah.
able to crystallize such things. So which is why you see mutual fund always have that hedge. Right. So because of the professional management that comes with mutual funds, you have a designated fund manager that their core responsibility is to stay ahead of the market, make investment decisions to optimize client returns. Right. Another thing you see that differentiates direct investment to mutual funds is the risk profile and diversification. In a mutual
Yeah.
fund, you tend to enjoy diversification because of the large pool of funds. Right. The money is now a lot for the fund manager to spread across different instruments. Take, for instance, if you want to buy just treasury bill, you will be looking at roughly 5 to 20 million. Okay, you want to now buy a bond, you'll be looking at 20 million. That's for an average retail investor. Even me, I don't have 20 million in my account, right? But if I buy into a mutual fund, I can gain access to all of these instruments. So
Correct.
if you take, for instance, you will see mutual funds always give an alpha to what the ordinary market is doing. I mean, if you look at NSC, for example, the All-Share Index has done about 42% this year, right? And our Smart Beta, which is also an equity fund, has done about 52%. That just goes to show you the edge you see in a mutual fund compared to direct investing.
Thank you so much, Ayo. Thank you so much, Ayo. I mean, for me, what I'm hoping people picked out is the fact that you passed on the burden to a to a fund manager, and it also gives you the opportunity to diversify your portfolio across asset classes and across currencies. Thank you so much. Taking it further, I mean, in terms of why we're here today, I'm going to come back to Tunde now. Tunde has given us a brief insight as to what mutual funds are. Briefly, what are capital gains taxes? I mean, this is something we've been hearing a lot in the news. I'm sure, I'm sure some Gen
Has
Zs,
been trending
even
actually.
some elderly people might not even know what this thing is. So briefly, I mean, just help us.
Okay.
What's the CGT?
Okay. Thank you, Muyiwa. So for CGT, that's capital gains tax. It is actually a tax that is being charged on the profits that you make or the gain that you make on when you dispose a chargeable assets. And when I say chargeable assets, it could be a property, it could be a land, different assets, different classification of assets, even though not all assets are chargeable when it comes to CGT. So CGT had actually been in existence for long. As a matter of fact, it had even been in existence like 10 years before even the withholding tax was even introduced. So, but then somewhere along the way, it came in as a decree, it became an act. Then for many years, when it comes to the investment space, there was no focus on CGT. It's more like a legal gray area, or regulatory gray area. But in 2021, the Finance Act came and actually gave an explicit determination when it comes to the gains on investment. So generally, capital gain tax is the tax that is being charged on the gains that you've made on a chargeable asset. Yeah.
Okay. Thank you so much. I mean, that's pretty straightforward. I mean,
Also,
yeah. So
just to add a bit to it, right? I mean,
yeah, go ahead,
it's not
please.
like it's a new tax that was introduced, right? It has been in existence for a while.
Yeah.
So it's just the new changes that has made it be the buzz that everybody is now becoming more aware.
That's making it trend, right?
Yeah.
Yeah. Well, I mean, that's why we're here today, anyway. So people can understand that it's not a new policy, and to understand the changes that have been introduced with the capital gains tax. I mean, it seems we're leaving Sheung somewhere. So Sheung has to come in now and take this thing even further. Sheung, why is it important for an investor like myself, the average guy on the streets, to understand what capital gains taxes are when investing in mutual funds? Why is it important for an investor?
I'll say it's very important, most especially as a smart investor. I mean, this is the major question you should be asking. Knowing fully well that government recently revised the capital gain tax from 10% to 30%. So that begs the question of how that's going to impact your mutual fund investment. So having like a clear understanding of the impact will inform you as an investor on what mutual fund to invest in that will most likely meet your financial goal. Also understanding the new capital gain tax would also inform you on how to assess your real return on investment. Now, the good thing about capital gain tax is there are exceptions and there are also reinvestment benefits. So for investors who earn a capital gain of over 10 million on an annual basis and reinvest back into the market, they are kind of exempted from, capital gain tax, as well as, investors who earn less than 10 million as capital gain in a year are also exempted from capital gain tax. So the whole idea is not to discourage investors from investing, but the whole idea is just to keep them informed about the benefits, of reinvesting back into the market. And so for us at First Asset Management, I would say tax is not something new to us. I mean, for our fixed income mutual fund, we pay withholding tax on commercial paper, on fixed deposits, and yet we still deliver a very good return. So if you heard when I mentioned our smart beta is, doing about 52%, our FBM balance fund as well is doing about 42%. So despite the fact that we are paying withholding tax, I mean, we are still very competitive. We are currently like number one in terms of return for our equity mutual fund, and even other fixed income mutual funds. So it's not to discourage investors from investing. It's just for you to keep you informed. So that's why we're having this, conversation, so that you don't get discouraged and miss out from opportunities.
Thank you so much, Sean. Thank you so much, Sean. So we'd like to hear from attendees. Currently with us now. We'll be putting up a poll. The poll question will be coming up in about 30 seconds. So just vote based on what you're familiar with. And the question is, how familiar are you with capital gains taxes in relation to mutual fund investments? So just pick whichever is applicable to you. I think it's going to be up for just about 30 to 40 seconds. We'd like to hear from you. Right. Okay. So, This is very okay. Oh, we have a split between not familiar and I would like to know more. Thankfully, that's why you're here today. So at the end of the session, hopefully those numbers will change by the end of this session. Thank you so much for participating in our poll. Moving on now, Ayo, what are the, I mean, for investors that, are conversant with what capital gains taxes are, and based on your own personal experience, as a fund manager, portfolio manager, what would you say are the common mistakes investors make when calculating or declaring their capital gains taxes?
Okay, thank you, Muyiwa. Okay, so to speak to some of the few mistakes we've seen investors make when making their capital gains assessment. My colleague already explained what the term capital gains, the profits you made on the disposal of your assets. So one thing we always notice is sometimes investors make a mistake in the cost price of their assets. So let me break it down for you, right? Let me use shares investment, for example. So you are an investor, you bought, let's say 500 units of a GT Bank at 100 Naira in the year. Then during the same year, you bought an additional 1,000 units at 250 Naira. So you're seeing that you're buying the same stock, but you're buying at different price, right?
Yeah.
In the same year, you bought an additional 1,000, let's say at 220 Naira. So now you've bought GT code 3 times in a year. You bought 500 at 100. You bought 1,000 at 150, and then you bought an additional 1,000 at 120. So in that same year, you now decide to sell part of your 2,500 units, and you make gain above 10 million. So that means now you have to pay capital gain tax, right? So we see that investors sometimes just use the most recent price for the one they purchase. So they will just use 120 Naira as the base price for their capital gain computation. Which is quite wrong, right? The right thing to do is to do a weighting of your portfolio. So what do I mean by that? Right? You've bought different stock at different price. So just do a weighting of each of those stocks. So for the scenario I just painted now, you bought 500 at 100, you bought 1,000 at 150, and the final 1,000 at 120. So if you do a proper weighting, so 500 over 2,500 times the price you bought, 1,000 over 2,500 times the price you bought, then you have a weighted average price of 128. So that means if you are computing any capital gain on the stocks of GT code that you purchased in that year, the base price you are using is 128, not your most recent price. So it is always right to use your weighted average price for any disposal you make in the same instruments. So that's one common mistake that we've seen that investors make during that period. Another thing is people forget that when you're making capital gain, the law is very nice. It permits you to offset any previous loss. I know some of us on this talk forex trader or crypto traders, right? So in a fiscal year, if you make any loss on your transaction, in the same line of instruments, then you make gain. You're not required to pay just the tax on the gain you're making. The law allows you to offset any previous loss you've made. The tax will be on the net position. So let's take for an example. I sold some shares during the year. I made a loss of 10 million. During the same year, I sold another stock. I made a profit of 50 million. My net gain is 40 million.
40 million.
Because the law permits you to offset the loss you initially make, then pay the tax on the net gain. So sometimes investors just take in the loss themselves and focus on the gain, that is what they are paying the capital gain on. No. The government are a bit nice now, so you can offset your loss. One of the things people also forget other costs, right? So when you are computing capital gain, it is not just the cost of the asset. There are other costs that comes in with the chargeable assets. So in an example of a physical property, maybe you have to transfer or you pay commission to an agent, right? Okay, let's even use shares. For the sake of financial instruments, you pay settlement charge, you pay the stockbroker commission. All of these costs are part of costs that should feed into the cost in your capital gain computation. I don't know if you get what I'm saying. So all of these costs, your commission, expenses you've incurred at the process of selling those instruments. So you factor those costs when computing your capital gain. I mean, so these are very few mistakes. Another thing that we used to see investors do, like when you, let me use the GTCO example I made earlier. I mean, you bought GTCO during the year and you sell later down the year. So GTCO declared an half-year dividend, right? So you got half-year dividend. I mean, it's quite funny that sometimes you see that investor we had the dividend they've received as part of their proceed, and you are just dashing the federal government's money. Federal government will not put money now, right? So the dividend you earn are not part of your proceed. So your capital gain, if I put it in simple terms, is just the selling price minus cost price minus any additional costs that you've incurred at the point of disposing the assets. Thank you.
Thank you so much. Fantastic, fantastic. I mean, you were very, very detailed with your explanation, and it might seem like a lot, right? But guess what saves investors all this stress? Investing in mutual funds, as we previously said. That would just save you all this stress, all this back and forth, and all this, crunching numbers. Investing in mutual funds will save you all this stress. Thank you so much, Ayo. Thank you so much, Ayo. Coming back to Shemun now. I mean, the question on everybody's lips is this tax applicable to mutual fund investors? Am I, as a mutual fund investor now, should I be worried about capital gains taxes?
Thank you very much. I'll tell you no, there's nothing to be worried about. The good news is the returns that we give on mutual funds is net of all fees. So the return you're generating is like the absolute return, the real return on investment. So that's factored in tax, that's factored all fees, management fees, and the like. So you are enjoying the real return on your investment. Another thing I want investors to know is the fact that portfolio manager is well informed on how to maximize this capital gain tax incentives. So like I mentioned earlier, if you're investing back your capital gain, you'll be exempted from the capital gain tax. So this is something that portfolio manager will continue to do to ensure that they continue to deliver a very strong return. So in summary, you're getting the net return, is nothing to worry about. And the fact that mutual funds, like Ayo mentioned, is managed by professionals. So it's just for you to sit down and allow your money to work for you while you ensure that the PM is delivering in terms of their job. So yeah.
Correct. Thank you so much. I want to say portfolio managers. So referring to portfolio managers as best asset management. Also referring. Yes. Thank you so much. Thank you.
I mean, it's about tax planning, right? So which, like you rightly said,
it's a tool for tax planning.
Whatever you're getting as a distribution from your investment in mutual funds are tax exempt, right? So the panic in the air can just douse because you don't need to be concerned because the portfolio manager has taken on the concern for you, ensuring that your funds can utilize judiciously.
Correct. Thank you so much. Thank you so much. Coming to Tunde, so we've heard from Shehu as to if a mutual fund investor should be worried, and basically the conclusion is that they shouldn't be worried. But what do you say?
They shouldn't be worried.
They shouldn't be worried. Yes, they shouldn't be worried. But I mean, in terms of the new tax regime in general, now this is going beyond capital gains taxes. Now, the new tax regime that we're expecting to come into play in January 2026, would it affect mutual fund investors in any way?
Okay. Okay. I believe it is like a double-edged answer. The reason is because it's going to favor the retail part of the economy generally. It's going to really favor them. Like, for example, if you're earning below 800,000 naira, your personal income tax is 0%. You're not paying. And even for companies, for small companies with turnover below 100 million, they're not paying taxes. And with net assets, I mean company assets below 250 million, they are not paying CIT. So, and in that case, what do you expect? More disposable income. So for retail investors, if I know that I'm not going to be paying like capital gain tax, which is no longer transactional, though I didn't mention it at the beginning, gone are those days when you make gains on disposal of assets. I mean, chargeable assets now in this case, you pay you'll be paying, I think till December 2025 anyway, you'll be paying like 10% charge on the gain. It was transactional. When you transact, it will be applied. Then going forward from 2026, it is no longer transactional basis. It's now going to be more like an advanced, a progressive regime, in the sense that it will be meshed together with your income band. So if as a retail investor, your annual, what you make annually is below 800,000 naira, in that case, even if you make gains on your capital that you disposed, you are not going to pay any CGT. So what that does is it increases disposable income for investors. So I expect more participation in that space. You know, when we are maybe before now, what you do monthly on your mutual funds and investment generally, maybe the cap is about 5,000 naira. It is expected maybe going forward from 2026 that you even do more. Because one thing about money, if you have more money and you do not have investment plan around it, before you know it, it has gone, because the bills will always be coming. So this new tax rate,
Yes, correct.
it favors like the retail side of the economy generally, of the population generally, and even for those that are between the band of 800,000 to 3 million naira per annum, there is a reduced, exposure when it comes to even personal income tax. So generally, it's going to favor like a good number of individuals anyway. But the focus on this new tax regime, the way I'm viewing it, is more like a Pareto principle. Like, okay, maybe there's a 20% of the population,
Yeah,
of the taxable population, that could even deliver
yes.
this revenue for the government. So why
You are
not
looking for,
them
yes.
from the over 80% of Nigerians? So generally, it's going to favor a part. Then for some other part of the economy, it may be expected to pay more when it comes to CGT. Imagine you being used to paying 10% flat on transaction when you make gains. Finance Act 2021, when you sell above 100 million, then the gain, you pay just 10,000 flat. But now it will now be paid. So if you're earning above 50 million as revenue for the year, I mean income for the year, and you'll be paying 25% as personal income tax, the same 25% will now be applied again on your capital gain. Even though the capital gain is also part of it, forms the
Yeah.
entire income made for the year. So what is important is the masses and the retail investors really benefit more money to invest. But like I mentioned, we need to start planning. 2026 is almost here. If we now
Yeah.
have it in disposable income, how are we planning to put it to use? Do we want to increase maybe the the number of or the frequency of largesse, like let me go and enjoy, or we want to have an investment plan around what will be coming? Thank you.
Thank you so much, Cindy. I mean, I like what you said so far, and it also influences the next question we'll be asking. But before we go to that question, I'm going to throw up another poll just to make sure that our attendees are still with us and they are paying attention. The poll question is up now. How do capital gains taxes influence your decision to invest in mutual funds? So we'd like to hear from the attendees. I mean, based on what you heard so far, how do capital gains taxes influence your decision to invest in mutual funds? So please go ahead and vote. It will be up in about 30 seconds. Significantly, I'm hoping it is significant. It's still a tight one, but I mean, it's still saying more to significantly. So, from what we're saying, a good number of attendees would be looking at mutual funds in terms of their capital gains taxes, in terms of their investments decisions going forward. I mean, we'll take that. Hopefully, the numbers will go up before the end of the session. Moving on to the next question now, as I had mentioned earlier, I mean, Tunde was already giving us insights as to what he sees coming in terms of policy changes in the capital gains taxes. I'm throwing this to everyone now, and I would like Sheil to go first. What are your expectations from these policy changes in terms of this new tax regime, capital gains taxes, PIT, CIT? What do you see happening with trends nationwide come January 2026. Sharon can go first.
Okay, thank you, Muyiwa. I'll view it from two angles, the positive and the negative. I mean, for us as Nigerians and as investors, we keep clamoring on, we want a better Nigeria. We want our
Yes,
Nigeria to be
so
like,
yes, so
developed economies. And you see, those developed economies, they kind of pay tax. Their tax is quite efficient. So for
yep,
Nigerian government, to bring it down to Nigeria, I think is a good one. The only issue that I have with it is when comparing the capital gain tax compared to other African countries is quite high. So for Ghana, for Kenya, they are within the range of 0 to 20%. So I mean, starting off with 30% kind of seem quite high. So I believe that government might have to go back to the drawing board, to reduce or review the capital gain tax so that it does not discourage even foreign portfolio investors from coming
correct.
into Nigeria.
Yeah,
For the positive side of things, I would say it will help drive our revenue as a country, and we'll see government, investing more in infrastructure, which will invariably lead to a better Nigeria that we've been clamoring on. So I would say on a balance of factor, is a good one because we are not so used to it. I mean, as a country compared to
yeah,
developed economies whereby everything is taxed. So, and the other good thing I like about it is the fact that it's graded. So,
yeah,
the
very
more
true.
you
Yeah,
earn, the more the more the rate that is applicable to you. So for the retail investor, I mean 0%, they are kind of exempted. But for the wealthy ones, at least you should be able to cater, add your own quota to the Nigeria's economy. So I'll say it's a good initiative. But I believe that they might have to revise or review the capital gain tax maybe to about 25% or 20%, so that it's quite
mm,
attractive to foreign portfolio investors. Although we don't see them play so much in the equity market currently in Nigeria, I mean, but in the long run, it's something that we'll want to, implement so that they can also enjoy what Nigerian investors are also enjoying.
thank you so much, Sharon. Today is smiling. He's ready to go. Oh yeah, today go. Oh yeah, go.
She has said it all, actually. She has said it all. Even though she mentioned that she's looking forward to a further review, the coming years, I believe. It might be too early, to say that, because
Yeah, yes,
evidently, if it
yeah.
becomes very, very clear that the new tax system really improve government revenue, alleviates poverty to a very reasonable level, then I think we might have to maintain the status quo and continue with the efficient way of collecting our taxes. Thank you.
Mm, mm.
So, I mean,
Ayo.
I sort of want to defy a bit from Tunde, right?
Oh yeah.
I mean, I'm not sure revenue generation is the main driver for this change in policy, right? Because if you look at it historically, capital gain has not really been a significant contribution to government revenue. I mean, just 2024, capital gain was just about 52 billion out of 15 trillion that was generated from CIT and VAT purpose, right? I mean, so if it's more of a revenue driver, I mean, I struggle to see this level of significance this would contribute to the government bucket. I mean, so my own major concerns, right, is the sudden pressure that is going to be applied on the capital market. I know my colleague earlier mentioned as
Mm,
to the foreign investors, right? If the argument the government is making is that some of these foreign investors have double taxation treaty with Nigeria. And if you look at it in the large scheme of things, we have just about 16 countries that currently has a double taxation treaty in Nigeria. I mean, what that simply means is that if these foreign investors come to the country, they buy your instruments and they pay any capital gain tax, they can claim a refund when they go back to their own country. So, I mean, so they don't have to worry about the tax they are paying here, right? I
mm,
mean, we have
mm.
just, I think for the big ones, just United Kingdom has a double taxation treaty with us currently. US don't have one with us. So if I'm a US investor and I want to come and invest in your country now I need to take into account currency volatility. Now I need to also factor in a 30% CGT on my return. I mean, to me, it's a disincentive to these guys. And Michelle mentioned other African peer countries that are doing less than what we currently have. I'm not against tax, so trust me, I'm a very tax compliant individual. So tax is very good, right? But I think it was just almost too sudden because the market is just recovering, right? We just started to see
Mm,
gain market gradually, and you're bringing this to sort of shock the market. And there's still some bit of gray areas, right? I mean, for example, a foreign investor that has that has stocks that he has bought for as far back as 2020, 2019. I mean, there's still not a bit of clarity as to what the base the government wants to use. So, I mean, we might see some bit of fiscal amendments before the implementation next year to sort of clarify all of these gray areas. So, I mean, they're on the right path. It's a good thing. They're making Nigeria more tax aware. I mean, tax planning has become the song in everybody's household now. Everybody's sitting up with the whole new tax implementation. So it's a good thing, right, for us to be tax compliant. And also, the onus is also on the investor. I mean, as we're becoming more tax compliant, we also need to hold the government more accountable to ensure that the funds
very important.
So that's my own take, right?
Thank you so much. Thank you so much. I mean, yeah, I mean, it's, I mean, there are positives to it, but at the same time, but let's see how it plays out. Let's see how it plays out. If there are going to be any reviews, I think it will come into effect first, and they will see how well it participates in the markets, and before they make any reviews as such. But I don't really see any reviews happening between now and January, anyways. I feel this will come into effect first before any reviews can be put into play. Well, thank you guys so much. We'll be taking our final poll. Because we want to make sure our attendees are following as much as possible. And the question is, do you currently invest in mutual funds as a means of tax planning? I mean, I just mentioned something about tax planning. I'm sure people now, going forward, they are going to be very, very, very on point with how they're going to be managing their taxes going forward. So we'd like to hear from you. Do you currently invest in mutual funds as a means of tax planning? No, I would like to know. That's why I'm here. So taking it further, based on the responses you provided, my colleagues will be sharing the different mutual funds that we have available here at First Asset Management, and how you can use these mutual funds to actually take advantage of not being taxed, basically. So I don't know who wants to go first. Anyone can go first, because I mean, I'm throwing this out to the three of you. So any of you can go first. Who wants to go first?
Okay. You as rightly stated, this new regime, we expect people to be more focused when it comes to tax planning. You know, there's a popular statement that is always mentioned in the market. They tell you tax avoidance is legal, tax evasion is illegal. So what it means is, you need to start planning. When you plan very well, you know how to. In situation whereby you've already purchased a Nigerian stock and you've made a lot of gain, the turnover is even above 150 million naira, and you've made gain of above 10 million naira. Ordinarily, CGT should apply. But in situation whereby you know that if such proceed is reinvested back into the market to buy another Nigerian stock, you will be exempted from capital gain tax. It's still part of tax planning. And also, you also understand that if you invest in in a mutual fund, like generally, it helps. When it comes to tax planning, the portfolio managers they already have that set out. They already have the strategies to have a proper tax planning to reduce costs when it comes to management of the fund. So, and also, I also believe that this regime, habitual trading would reduce. There are some, they are habitual traders. They're buying, they're looking, they're selling, very habitual, and some of these habits, they don't really give value when it comes to the essence of even having a stock market. It's to have retention, is to have funds available for companies to run their businesses and grow the economy and the business. So we believe that this regime, we believe habitual trading would reduce. People will focus more on maybe stocks that could really deliver dividends. People will now be dividend minded, looking at long-term value for their money. Yeah.
Thank you. Do you want to shed more light? I mean, spoken generally now. Do you want to drill down on the mutual funds available as First Asset Management that investors can take advantage of in terms of planning for their taxes?
Okay, so looking at money market fund, for example, I'm a money market guy. I speak a lot when it comes to money market, money market fund. As of yesterday, this fund had even delivered above 18%. Looking at even the recent inflation figure, we can even see that the money market fund can even deliver a positive real rate of returns when it comes to investing, because some investors, they are very particular about that. That if inflation is this, what am I getting on this? A situation whereby a money market fund, for example, is even delivering that positive level for you, then why wouldn't you want to? So currently, it's performing, even though looking at the stock rate of the TBs, which sometimes can affect the movement when it comes to the returns on investment, but still, it's so defensive and it keeps delivering. So, and also looking at the bond fund, for example, some
Yeah.
investors they prefer the long term because money market fund can be seen more of like maybe a short term, it pays dividends quarterly. You know, I can save for maybe I want to travel by the end of the year. I'm going for summer or this, you know. But for bond fund, it's more like a long term, so you can also consider it. And as a matter of fact, the bond fund is still returning double digit as well. And there are some investors too. They are so comfortable when it comes to their ethics. They prefer investment that can really be maybe ethical based. We have
Yeah.
other with underlying assets like the Mudaraba, Musharaka, you know, some of all these ethically allowed investments. And at the end of the day, they also make good returns on investment because it's also delivering double digits. So
Correct.
that's
Correct.
like the summary of
Thank you
those
so
things.
much.
So why
Thank
not
you so
pick one
much.
of them today?
Yes, yes. I mean, as you rightly explained, I mean, the money market fund, the bond fund, the halal fund. I mean, these are mutual funds that, I mean, have unique features, and they give you the advantage of investing as a collective, and also giving you returns without having to worry about the day-to-day management of these funds, and without having to worry about the, I mean, tax implications and finding taxes and whatnot behind investing in these funds. Ayooluwade, do you want to speak more on the other mutual funds we have available here at First Asset Management?
Yes, Muyiwa. Okay, so thank you, Tunde. You have spoken very well on money markets, the bond fund, and the allowed fund. I mean, personally, I have a bit of investment across all of these three. I mean, even as my small retail funds, I'm beginning to put
Investor.
gradually investor UI. All right, so I mean, we have also USD mutual funds that investor can take advantage of. I mean, we have a bucket of product across each of your needs, depending on your investment objective. So one is a dollar fund, right? So the dollar fund are for retail investors like myself, right? With just as low as $100, you can gain exposure to that fund. And typically, what does that fund does is invest in USD assets. I mean, if you look at rather than keeping your USD fund just in the bank, earning you next to nothing, you can put it in the dollar fund. And if I just give an estimate of what the fund has done year to date, about 7.3%. I mean, on a dollar assets return, that is quite impressive, right? And if you're an investor that has a bit of more risk appetite and you want something with more return, we have the specialized dollar fund. I mean, like the name sounds, the specialized for the special ones, we have special ones, right? So for
Yeah.
that fund, the entry level is about $10,000, right? And it has more exposure in terms of the asset basket it can invest in. I mean, like your sub-Saharan instruments, Egypt, Angola. I mean, just taking in some bit of more basket of instruments to improve the return. The fund has done about 8.3% this year, and we also have the blended dollar fund. Right, so we'll be speaking about capital gain in Nigerian market. I mean, there's some that also wants to invest in global equities market. I mean, I want to own a share of Apple, but how much is the dollar that I have? So what can I do now? Let me buy into the blended dollar fund. I can gain such exposure and also augment my return. The fund is doing about 10.52%, which is quite decent for a balanced USD fund. So, I mean, depending on what you need, we have one that meets your product. I know we have a lot of youth currently that does work from home, you earn in USD. So don't let your fund just sleep in your USD account.
Yeah,
It's
so
time to put your money
valid
to work.
funds. Yeah. Thank you so much, Ayo. I mean, also, as you rightly said, I mean, we have not just mutual funds that are diversified across asset classes, we have mutual funds that are diversified across currencies. So we have dollar-based mutual funds, and even
Correct.
within the dollar-based mutual funds, they are also diversified across dollar asset classes, which is actually giving you even more diversification. So thank you so much for that explanation, Ayo. Sheung, we'll be ending with you, and we'll be moving on
Okay.
to the Q&A session.
All right. Thank you, Muyiwa. It's been an insightful session today.
Yes, it
Like my
has. Yes, it
colleague,
has.
like my colleague has mentioned, and I know I mentioned this earlier as well, that all returns generated via mutual funds are net of all fees, net of all taxes, net of annual management fee, and the like. So the return you're getting is net of all fees. So like AY mentioned for dollar fund hovering around 6%. Tony also mentioned about 8% for the bond fund. So we also have different mutual funds. We have up to 8 mutual funds. So I'll say that at First Asset Management, we have one financial product for you that will meet any of your obligations. So if you're a low risk investor, we have a product for you. If you are a high risk investor, we have a product for you. If you want a balance between the fixed income and equity, we also have a product for you. So for our equity fund, we have the FBN Balanced Fund. We also have the FBN Smart Beta Equity Fund. So like I mentioned, investment in equity. So the Balanced Fund, the name implies balance. So a mix of both fixed and equity funds. The current return on the portfolio is about 42%, and the minimum is 50,000. So you don't need to have so much money, to invest in any of our products. We have products that are as low as 5,000 naira. And the good thing about it, because it's a mutual fund, you can come in and exit at any point in time. So it's open-ended. You don't have to stay in for maybe 1 year before you have access to your fund, although we have a minimum holding period. So for our balance fund, the minimum holding period is 90 days, after which if you want to exit from the fund, you have 100% of your return, allocated to you. However, if you're liquidating before 90 days, you'll be subject to 20% of the income earned. So not on the capital, on the income earned. So I'll say it's quite attractive. Also for our smart beta fund. So if you want something that is on the high end, more exposure to equity, we have the smart beta equity fund. The return on that is 52%. Inflation now is at 18%. So imagine 52 minus 18, that will give you your real return on your fund. So it's quite
money.
Honestly.
So it's quite I'll say it's quite attractive. Similar sentiment as well applies to it. So for all our mutual funds, they are open-ended. So there's none that is closed-ended. Open-ended in the sense that you can call for your funds, you can enter, free entry, free exit. You don't have to pay to enter. So far you have 5,000 naira, you have something available for you. So I would advise that you don't miss out on the opportunity, even with this capital tax gain. Like I mentioned earlier, the return we give to our customers or our investor is net of all fees, net of all taxes, net of all management fees, or any fee you can think of. So for us to still deliver 52 just speaks a lot to, our services and the fact that we know our onions.
We definitely do. We definitely do, Cheryl. Thank you so much. I like the fact that we've broken it down in different ways in terms of our mutual funds. We've broken it down per currency. The fact that you can invest both in Naira and USD. We've broken it down across asset classes in the fact that you can invest in fixed income backed mutual funds. You can invest in equity backed mutual funds. And we've also broken it down in terms of risk profile, right? We have mutual funds that cater to low risk investors, mid-level risk investors, and investors that want to take on a higher level of risk for the potential of higher returns that are so high that they even beat what inflation is currently offering or what inflation is currently doing. Thank you so much, guys. That was really, really insightful. We'll be taking questions now. I think we have just about 12 minutes left, so we'll take as many questions as we can. There are a lot of questions in the Q&A, and I'm excited because that means people are really paying attention and they really want to learn more. We'll start off where we ended. So Shane, we'll be coming to you. And one of the attendees is asking, what is the difference between other mutual funds and the equity-based fund? It's a very straightforward question. I think maybe this attendee is looking to invest in an equity fund. So the attendee would like to know what's the difference between our mutual funds and the equity-based funds.
Okay, thank you. I'll say equity-based fund is also a mutual fund. So I think the question should be, what's the difference between a fixed income mutual fund and an equity mutual fund? Yes. So equity mutual fund, like I mentioned, they are all mutual funds. So mutual funds, investor A, investor B, all kind of investors, pull funds together and then invest in a particular asset class. So for the equity mutual funds, like I mentioned, we have two. We have the FBN Balance Fund. We have the FBN Smart Beta Fund. Now, the exposure to equity in the smart beta fund is higher than the exposure to equity in the FBN balance fund. So as an investor, before you invest in any mutual fund, I mean, the major thing you have to consider is your risk appetite. Are you
Yeah.
risk averse? And also understand what your investment objectives are as well. Would also inform you on what mutual fund you want to invest in. We also have the dollar fund. For those who want to hedge against currency devaluation, that product is also available to you. So you, first of all, understanding your objective as an investor, understanding kind of investor you are. If you're a high risk investor, a low risk investor, will now determine what mutual fund we recommend to you. But in all, I mean, our services is a one-stop shop to any financial service you're looking for, be it on the low risk or on the high risk, or on the medium risk, we have you covered.
Thank you so much, Cheryl. Thank you so much, Cheryl. We have another question here. I'll be directing this to Tunde. And the question is also very straightforward because I think people are asking questions that will make them make decisions on the spot. So this attendee is asking, how is a money market fund or a fixed income backed mutual fund better than treasury bills? I know treasury bills were really popping at some point, trending, 23, 24%. So this attendee would like to know how is the money market fund better than investing in the treasury bill directly? What are the advantages?
Okay, thanks a lot, Muyiwa. So for money market fund, it is open-ended. Shima has rightly mentioned that in the sense that free entry, free exit. And for every fund manager, the dream or the goal is always to outperform any benchmark. So for money market fund, for example, the benchmark is 91-day treasury bill. So, regardless of what, even no matter the rates that or the returns that treasury bill is delivering, the objective of the portfolio is to even outperform the benchmark. Currently, the last top rate when it comes to 91-day treasury bill, I think is around 15%. So imagine a money market fund even delivering over 3% more than that figure. So anybody is about money. In most cases, it's about the value you're getting on an investment. So it is easy to tilt around the money market fund, for example, when it comes to return on investment, because time after time, year after year, it has continued to deliver even beyond the treasury bills and any benchmark you can pair, even if it is the fixed income fund, even if it is the equity fund. So for fixed deposit or fixed income generally, it's still about your objective. Some prefer, I don't want movement on the returns on my investment. If it is 10%, let me know that it's 10%, and at the end of the year, I'm getting my 10%. Unlike the money market fund that changes. Money market fund, for example, but always have something in mind, regardless of the fluctuation in the returns on money market fund, your capital is preserved. Even the interest that you've earned, let's say for today, the interest is 18.03%, and I've made that amount divided by 365, prorated to determine what I'm making today. I've earned it. Then the following day, if it drops to, let's say, 18% on the dot, it's not going to impact or affect what you made yesterday or today. It's not going to. It's just going to be on that day. So on the average, majority still prefer the money market fund. Particularly, I mean the low risk investors that just want to have their principal to be covered, interest earned to remain the interest that has been earned. Because there are some mutual fund, interest earned might not exactly be a realized profit till you choose to exit and take out the profits. So that's more like the summary. Taking that again, money market fund is flexible. The
Yeah,
returns is usually higher than even the benchmark, which is the treasury bills, particularly the 91-day bill. Thank
yeah.
you.
So, Muyiwa, let
Thank
me
you so
just
much.
let me just lend my voice to that also, right? I mean,
Yes,
so
but
what
the
you
next question
tend
is coming to you, so please go ahead.
what you tend to see with treasury bills, like when you go into a treasury bill, pretty much you are locked in for the duration of that instrument, right?
Yes,
So when you buy
yes,
1 year, you buy 180 days, you're locked in.
yeah,
And when you see interest rate change in the market, your stock, right? But the good thing about the money market fund is it trades what the market is currently doing. It is market reflective, right? So you enjoy the movement with the market. As the market is going up, you enjoy the benefit of the fund. Like Tunde has said, the return is daily, right? So what you get each day It's a reflection of what the market is doing. So let's say your market was doing 11%, you bought a treasury bill, you were locked in that period, and rates reversed all the way to 18, 19. You're stuck in your 11%. If you decide to sell, you'll be making a loss. But if you're in a money market fund, you would see the reflection of the improvement in rates in the return of your investment.
Thank you so much, Ayo. And we'll be taking the last question because we're pressed for time. And this question is going to you, Ayo. And the attendee would like to know, we've mentioned USD mutual funds, we've mentioned our Naira mutual funds. He wants to know, what is the best option to invest in, Naira or USD? I know your answer, but just go ahead. Go ahead.
Yes, so which one is the best, Naira or USD? I mean, one thing with investment is you need to align it with your objective. Our objective varies, right? I mean, if for example, I'm somebody that has USD obligation, let's say I intend to travel down the line, ultimately I can start investing in USD. So by the time I need to actualize those actions, I have something in USD already. But if you're just trying to play dilly-dally, I mean, just look at the objective you're trying to achieve. Do you want capital growth or do you want stable returns, right? If you're looking for stable returns, I mean, you might look at the money market fund, which gives you quarterly dividend that you can reinvest. But if you have obligations or you're looking at long-term investment, then you can look at the USD mutual funds that you can put your funds in and get decent dollar returns on your investments. I mean, so it all boils down to marrying your risk profile and your investment objective, because each of these funds have different objectives. If you're looking to play fast on the currency and you don't, everybody has a crystal ball, right? I mean, this year we've seen the Naira appreciate against the dollar. For somebody that has converted Naira to 1.6, that because they want to quickly take, I mean, they will be biting their fingers right now. But if you're somebody that had a dollar need, you won't even care about what is currently going on, because you know the dollars you are investing are going to be targeted towards different ends, right? I mean, so it's all about having a clear direction as to what you want to achieve. Then look at the vehicle that will take you there without any bumps on the road.
Thank you so much, Ayo. I mean, so in a nutshell, assess your investment objectives, assess your currency objectives, and I think for me, in summary, you should actually do a bit of both. I mean, based on what we've seen so far in the past 2 to 3 years in the financial markets. Yeah, exactly. Currency diversification. Yeah, so you should actually invest in a bit of both. So, to the attendee that asked the question, we would like you to start today with both the Naira and the USD mutual fund. Thank you so much, guys. We've come to the end of the session. Thank you all for your contributions. Thank you to my colleagues for all the insights you've provided today. Thank you for all the attendees that attended and stayed to the end of the session. Please, if you would like to know more about First Asset Management, our Bootcamp series, please follow us on all our social media pages at First Asset Management, which is FIRSTASSETMGMT. And please reach out to us. We'd like to hear from you. For those who are willing to sign up as quickly as possible, please send us an email and talk to us at firstassetmanagement.com. I mean, this will be shared with you on the chat box. So please reach out and we will be looking forward to having you on board. Thank you all once again. I also have to mention, we're not tax experts. We only give our insights based on our personal experiences. For your tax needs, please consult actual tax consultants as to how to navigate the new tax regime that's coming into play in January 2026. Remember, in investing, it's not what you earn that matters, is what you actually earn after taxes have been deducted that matters. Let's all enjoy the rest of our day. Catch you at the next edition of our Bootcamp series. Bye.